Welcome. This is part two to the time value concepts. I'm breaking them down for a reason. I want them to be shorter so it really gives you a chance to dwell on the concepts of each video. I don't really want you rushing through any of these so that you can actually embody the knowledge. With that, we're going to continue with the future value interest factor of an annuity, or finding the future value of an ordinary annuity, starting with the next slide. The reason why the future value of an annuity is slightly more difficult than the future value of an ordinary sum is for the reason that there are only two variables in the preceding equations compared to the value of an ordinary annuity, the future value of an ordinary annuity, where you're now looking at time, interest, and series of payments, as opposed to just time and interest like you did in the previous. The easiest way to visualize the future value of an ordinary annuity would be to utilize diagrams showing payments received over a period of time. This is the most time-consuming way of doing it, but it is the easiest way to visualize. So after I show you a diagram of how it works, we're going to move on to actually utilizing an equation for it. And the diagram, of course, is on the next slide. Here's a diagram. It shows you the future value of an ordinary annuity of $2,000 over a 4-year period at 5% interest. You're looking and you might ask the question, why was there more interest after year 1 than there is on year 4? Year 1 has been invested, this $2,000 invested in year 1 has been invested for a longer period of time. So year 1 is going to have interest compounded on it from year 1 to year 2, from year 2 to year 3, and then from year 3 to year 4. Where on the annuity of year 2, it's having interest compounded from year 2 to year 3. Year 3 is just having interest compounded from year 3 to year 4. And year 4 has no compounded interest because the annuity has matured by year 4. So the most amount of interest has been added to year 1, which gives you a total future value of $8,620. And again, that's the easiest way to draw it out to show you. And on the next slide, we're going to go back to utilizing the equations, which this equation is going to utilize the future value interest factor of an annuity. Now let's go to this slide. The future value interest factor of an annuity times the payment, or that equal series of payments, that annuity over that time frame, is going to equal the future value of the annuity. So payment times future value interest factor of an annuity equals the future value of an ordinary annuity. On the next slide, I'm going to show you another chart like I did with the preceding two and show you another example of how this works. And then we're going to move on to the present value interest factor of an annuity. I want to pause and say, if I'm going too fast or the slides are going too fast for you, pause between each slide and really grasp the concepts. There's no need to rush through this slide or rush through this course in the 15 to 20 minutes it takes to get through the entire course. Please take your time, grasp the concepts so that you can really utilize and apply these concepts to your life and your financial future. If we're going to find the future value of an annuity in this equation, we're going to utilize the numbers. The payments are going to be $10,000. And we're looking for the value, or the future value, over the course of 5 years that has compounded 10% interest. And in this equation, our future value interest factor of the annuity is going to be 6.1051. So our payment, which is 10,000, multiplied by our future value interest factor of an annuity, which is 6.1051, is going to equal $61,051. So the future value of this annuity over the course of a 5-year span at 10% interest with a $10,000 payment is going to be a value of $61,051. Again, if I am going too fast in any of these slides, take your time, pause it, listen to it over again. You really want to grasp these concepts because you really want to apply these concepts to your financial plan to make you a more diverse planner in your family or personal lives. Again, if you want to do the discounting for an annuity or find the present value of an annuity based on some future value amount, so when would you utilize this equation of finding the present value of an annuity? Let's say, for instance, you won the lottery and your cash out is $50,000 of payments at 10% interest compounded over the course of 5 years. So you're going to receive 5 payments of $50,000. That's receiving 10% interest over that period of time. And you have a company that offers you $100,000 in lump sum money in exchange for your lottery ticket to receive those payments. Now what you want to do is to find the present value of that annuity to see if the present value is worth more today than that $100,000. And you can see here that if you multiply $50,000 times the present value interest factor of that annuity, which is 3.7908, you're going to receive a value of approximately $185,440 roughly, which is clearly worth substantially more than the $100,000 that they offered you as a financial company to take that lottery ticket. And if this is the case, you would obviously reject that lump sum and you would want to receive those annual payments. The final equation that we're going to show you is estimating your annual savings. You may want to figure out how much money you need to save over a given period of time to achieve a certain future value at a particular time and interest. To calculate this savings, you need to use this equation here, which is very easy. The future value of an annuity divided by the future value interest factor of an annuity is going to show you the payment that you need. Simple as that. This is the conclusion of our second segment on tools for financial planning. The third segment is going to be on using tax concepts for financial planning. I look forward to having many of you return again for this video series. Thank you very much for listening. Enjoy your evening.